You lost money today, and yesterday, and every day before that.
Every Bitcoin transaction you have ever made is written down forever, in public, on a ledger anyone on earth can read. That sounds like the record-keeping problem is solved. It is not. The chain remembers where coins moved. It does not remember what you paid, what exchange you used, which coins were yours, why you moved them, or what your accountant will ask for 3 years from now. That is the trap. People hear public ledger and think the records are handled. Then tax season shows up, an exchange export is missing, a wallet transfer looks like a sale, and suddenly the permanent public record is not enough. Today we fix that. Not with tax advice, not with complicated software. With a simple paper trail you control. This is Exit Velocity. In this episode, we are going to separate 3 things. People constantly mix together. What the Bitcoin blockchain knows, what an exchange knows, and what you need to know to stay organized. This is educational record-keeping content. It is not tax advice and it is not legal advice. For filing decisions, use a qualified professional. The goal here is more basic and more powerful. Make sure future you can answer simple questions quickly. When did I buy? What did I pay? Where did these coins go? Was this a sale or was this me moving coins to my own wallet? If you can answer those, you are far ahead of most people. The point of Bitcoin is ownership, but ownership without records creates a different kind of dependency. You might hold your own keys, but if the only proof of your cost basis lives inside an exchange account you barely use anymore, you are still depending on someone else. You own the asset. Now you need to own the paper trail. Start with the thing people get backwards. The Bitcoin blockchain is permanent and public. It records transactions between addresses. It shows that a certain amount of Bitcoin moved from one address to another at a certain time. That is incredibly powerful. It is also not the same as your personal records. The chain does not know your name. It does not know your intent. It does not know what you paid in dollars. It does not know whether an address belongs to you, to an exchange, to a merchant, or to someone you paid. It does not know whether a transaction was a purchase, a sale, a gift, a payment, or just you moving coins from a hot wallet to cold storage. So there are 2 ledgers in your Bitcoin life. The first is the public ledger. That one is global, permanent, and outside your control. The second is your private context ledger. That one records the human meaning around the transactions. Date, platform, dollar value, cost basis, wallet, memo, and reason. Most people only respect the first ledger. They talk about the blockchain like it magically solves every record-keeping problem. But the second ledger is the one that saves you time, stress, and money later. The public ledger can show movement. Your records explain meaning. Here's a simple example. You buy Bitcoin on an exchange, then move it to a hardware wallet. On chain, coins left one address and arrived at another. Without context, that could look like a payment. With your records, it is obvious. Internal transfer to cold storage, not a sale. Same chain data. Totally different meaning. Here's another example. You send a tiny amount first as a test transaction, then send the rest 5 minutes later. Future. You may look at that and wonder why there are 2 sends, why one amount is so small, and whether something went wrong. One memo fixes it. Test send, then final transfer to cold storage. The transaction did not change. Your ability to explain it changed. That is why record keeping is not optional bureaucracy. It is how you preserve the story of your own money. The most common answer is, the exchange has my history. Maybe. For now. But that is a fragile plan. Exchanges change their export tools. They change file formats. They merge products, rename fields, remove old reports, lock accounts, restrict withdrawals, sunset services, or get acquired. Sometimes the export exists, but it is incomplete. Sometimes it has trades but not deposits. Sometimes it has deposits but not cost basis. Sometimes the file is technically available, but the format is so messy that you only discover the problem when you need it. And most people did not use one exchange forever. They used one app first, then another because fees were lower, then another because a bank connection worked, then a wallet, then a hardware wallet. 5 years later, their records are spread across old emails, screenshots, exchange CSVs, bank statements, and memory. The exchange only knows what happened inside its walls. Once you withdraw to self-custody, the The exchange does not know your future wallet moves. If you send coins from your hardware wallet to another wallet you control, the exchange cannot label that. If you consolidate UTXOs, the exchange cannot explain why. If you later send coins back to an exchange, the exchange may see a deposit, but it does not automatically know the original cost basis of those specific coins. This is the uncomfortable middle ground. Bitcoin gives you sovereignty, but sovereignty moves the paperwork back to you. That is not a bug. That is ownership. But it means I'll just ask the exchange later is not a plan. And there is a second problem. Memory gets worse exactly when the stakes get higher. The transaction that feels obvious today becomes vague later. You will not remember which wallet was temporary, which transfer was a test, which coins were bought for long-term holding, and which movement was connected to a payment. The record has to be made while the context is still fresh. Your goal is not to become a tax expert. Your goal is to avoid showing up with a pile of mystery transactions. A good professional can help you interpret rules. They cannot magically reconstruct context you never saved. The chain remembers coins. The exchange remembers a slice. You need to remember the context. Here is the practical core of the episode. For every Bitcoin transaction, record 7 things, not 30. 7. 1. Date and time. Use the actual transaction date, and if possible, preserve the time zone from the source. This keeps your records lined up with exchange exports, wallet history, and market pricing. 2. Transaction type. Buy, sell, swap, send, receive, gift, payment, or transfer between your own wallets. This one label prevents a lot of confusion later. 3. Amount of Bitcoin. Record it in BTC, and if you like thinking in sats, record the sats too. Do not round aggressively. Tiny differences matter when you reconcile. 4. Dollar value at the time. If you bought on an exchange, this is usually on the receipt or trade confirmation. If it was a transfer, record the best available value for context and mark it as a transfer so you do not confuse it with a sale. 5. Cost basis. Plain language. What you paid for the coins involved, including relevant fees. This is one of the big ones. If you do not know your basis, you cannot easily answer gain or loss questions later. 6. Platform or wallet. Which exchange? Which wallet? Which account? Was it cold storage, a mobile wallet, a Lightning wallet, or a business wallet? The label matters because future, you will not remember every address. 7. Memo. One human sentence. Weekly DCA buy. Moved to cold storage. Sent to my own wallet. Paid invoice. Gift. Test transaction. This is the cheapest and most underrated field in the entire system. The two people skip are cost basis and memo. Those are the two that hurt later. Cost basis answers the math. Memo answers the story. Think about wallet-to-wallet transfers. A transfer between your own wallets is not automatically a taxable sale. But if you do not label it, it can look strange later. Coins left one place. Coins arrived somewhere else. Was that a sale? A payment? A transfer? Your memo answers that in 5 seconds. This is why the system should be simple. If it is too complicated, you will not use it. You do not need a perfect institutional accounting system to start. You need one spreadsheet you actually maintain. Date, type, amount, dollar value, basis, platform, or wallet, memo. Every time you touch Bitcoin, make the entry. That is the habit. The habit matters more than the tool. Now let's talk about the part that makes people nervous. Taxes. Again, this is general educational framing, not tax or legal advice. Rules vary by country, facts matter, and you should use a qualified professional for filing decisions. But in plain language, there is a useful distinction. Some actions are mainly record-keeping events. Other actions may be reportable events. Buying Bitcoin and holding it is generally not the same as selling. Moving Bitcoin between your own wallets is generally a record-keeping event, not a sale. But selling Bitcoin, swapping one asset for another, or spending Bitcoin on goods and services can create a gain or loss question because you are disposing of something that may have changed in value. Notice the phrase, gain or loss question. To answer it, you need records. What was acquired? When? For how much? What was disposed of? When? For how much? Which lot? What fees were involved? What was the reason? The tax question and the records question are connected. Good records do not make taxes disappear. Good records make the conversation answerable. Bad records create panic. You open a tax tool, import files from 3 places, and suddenly it says you have missing basis, duplicate transfers, unknown deposits, and unlabeled withdrawals. That is not because Bitcoin is impossible. It is because the context was not captured when the event happened. The best time to fix this was when you made the transaction. The second best time is now. Here is what to do this week. Keep it small enough that you actually finish. First, make an inventory. List every place you have ever touched Bitcoin. Exchanges, broker apps, wallets, hardware wallets, Lightning wallets, business accounts, old apps, anything. Do not solve it yet. Just make the list. Second, export your history from every exchange while you still can. Save the raw files somewhere you control. Do not only leave them inside the exchange dashboard. Use a folder structure that is boring and obvious. Bitcoin records, then year, then source. Keep the raw exports untouched, and if you clean them up later, save a cleaned copy separately. Third, start your forward ledger today. Do not wait until you have reconstructed everything from the past. That is how people never start. From today forward, every transaction gets the 7 fields. Older history can be backfilled gradually. Fourth, label your own wallets, not on chain, in your own records. Cold storage, mobile spending wallet, exchange deposit, business wallet, test wallet. The label turns addresses into something understandable. Fifth, keep evidence with the entry when it matters. Trade confirmation, exchange export, invoice, receipt, screenshot, or wallet note. You may not need all of it, but if a transaction is unusual, attach context now. Sixth, schedule a monthly records check. Put it on the calendar. 10 minutes. Open the spreadsheet. Compare it against the wallet or exchange activity and make sure nothing is missing. The monthly habit keeps this from becoming a once-a-year emergency. This is not glamorous. It is control. The whole point is that you should not need to beg a platform for your own history later. There are a few mistakes I would avoid immediately. Mistake 1. Treating every withdrawal as a sale. If it was your own wallet, label it as your own transfer. Mistake 2. Assuming a tax tool can fix missing context. Software can organize data. It cannot know why you moved coins unless the data says so. Mistake 3. Ignoring small test transactions. Those little sends are exactly the ones that become annoying later, because nobody remembers them. Mistake 4. Mixing personal, business, and family activity in one unlabeled pile. If you have different purposes, separate the records clearly. Mistake 5. Waiting until tax season. By then, the work is archaeology. Do it when the transaction happens and it takes less than a minute. The goal is not perfection. The goal is to reduce mystery. Mystery is expensive. Clarity is cheap if you capture it early. If you want the spreadsheet already built for this, that is what the Bitcoin Holder Toolkit is for. The 7 fields are there. Cost basis tracking per lot is there. A clean view of your stack is there. It is plain Excel and Google Sheets that you own outright. Offline, no account, no subscription. It is not a tax service. It is not financial advice. It is a record-keeping system for people who want their Bitcoin paper trail in their own hands. The chain will remember your coins forever. Make sure you remember the context, because self-custody is not only about holding keys. It is about holding the story of your money in a form you can actually use. Your assignment this week is simple. List your platforms, export your history, start the ledger today, and label your own transfers. Do that, and you have already moved from platform dependency to personal control. This is exit velocity. Own your records. Think in Bitcoin.